Hi, this is Tom Jessup with New American Funding. I am a loan consultant and wanted to direct this presentation towards first-time homebuyers, and I'll be discussing some rent versus buy scenarios, the advantages to owning rather than renting, and I'll be discussing also the steps to getting pre-approved for a home loan. We are a direct lender located in Orange County, California. Been in business here for 15 years. We have a great staff dedicated to processing, underwriting, and funding your loans in-house. And we offer several varieties of loan products and programs that might fit your needs. So with that, we will get started with the presentation. Thanks for your time. So here's the first example of a rental versus purchase scenario. This house is listed in Santa Ana for $185,000. The rental move-in cost would be about $4,500. That's your first and last month's rent plus any security deposit. If you were to purchase this property with an FHA loan, you'd have the 3.5% down, $64.75, and then your monthly payment would be $826 for principal and interest, $288 for taxes and insurance, $185 for monthly mortgage insurance, and so your total is about $1,301, which is a couple $100 less than a rental. Sure, you'd be paying about $2,000 more to move in, the down payment versus the move-in cost and the rental, but you'd be recouping that cost with the savings after about 10 months. Another example we have is a condo listed for sale in San Clemente for $400,000. The rental move-in cost would be about $9,600. That would be your first and last month's rent plus a security deposit. If you were to purchase this property with an FHA loan, your down payment of 3.5% would be $14,000 plus your monthly payment would be $1,763 for principal and interest, $504 taxes and insurance, $441 mortgage insurance, and about $250 for HOA dues. Your total housing payment with the loan would be $29.72. So it's over $200 less a month to purchase this as opposed to renting it. You would have to come in with a little bit more for the down payment versus the rental move-in cost, but you would recoup that at about the 18-month mark. Now we're going to look at a 5-year analysis on your buying versus renting on this property, the one we were looking at for $400,000. So your total monthly savings over 60 months would be a little over $14,000. The other part of the analysis is the equity that you gain by buying as opposed to gaining zero equity through a rental. In Orange County since 1990, the rate of appreciation on real estate has been well over 5 or 6%. So I'm using a very conservative annual appreciation rate of 3.5%. So over 5 years, you'd gain a little over $75,000 in value in your property, in equity. And also, as you pay your monthly loan payment, you'll be chipping away at your principal balance. So over 60 months, you would have reduced your balance by a little over $40,000. So over 5 years, purchasing this property would save you about $130,000. $130,000 that you would have gained by buying this property as opposed to renting this property. Rental, you would have gained nothing. By buying, you gain $130,000 in this scenario. So by buying this property, not only do you gain the equity over time, but also you get to enjoy tax write-offs. And these are the items that you are able to deduct from your income taxes. Your mortgage interest, any points that you pay obtaining the loan, real estate taxes that you pay annually, your mortgage insurance premiums, home improvements, energy credits, tax-free profit on sale, home equity loans, meaning you can write off that interest that you pay on those loans and adjust your withholdings accordingly. So if this is making sense to you and you're seeing the benefits of purchasing a property as opposed to renting it, next steps you'd probably want to look at is getting pre-approved for the loan. And so uh, some of the things we look at are job stability, credit, your down payment, your assets, and things like that. So I'll just walk you through that. First is the job stability and income. How long have you been at the job? Will you continue to receive that income, etc. Um, if you're receiving anything like an overtime commission bonus or working a part-time job, those types of incomes we do want to see about a 2-year history of receiving that. Any retirement, Social Security, or annuity that you're receiving monthly we'll consider as fixed income, and we just want to see an award letter on something like that. Now, the next item that we'll be looking at is your assets. This goes for your down payment and closing costs. The underwriter wants to see that you have these funds available in your checking or savings or money market, and so you'll have to document those assets with a recent statement for that account. All your assets must be sourced and seasoned. If you're planning on using any cash from a safe, you'll want to deposit that into your account immediately because it does need to be seasoned for at least 2 months. The programs do not allow you to borrow a down payment from a personal lender, but if you are planning on getting a gift from a relative, that is definitely acceptable for assets and down payment. Next, you need to determine which program fits you best, and so that you can plan accordingly to have the down payment available when you're ready to buy. In California, there's a CalHFA program for first-time home buyers. As long as you qualify, you can put as little as 0.5% down. FHA standard minimum down payment is 3.5%, and your conventional financing requires 5% down. If you're a veteran, you can put as little as 0 down. So you just want to make sure that your assets are all documented and sourced and seasoned and be able to use these funds for the down payment. Also, you want to check the max allowable loan limits in your county in which you want to purchase. Everyone is different, so your FHA limit might be different from a conventional loan limit, and I can help you determine that. So if this is sounding interesting to you and you wanted to see about getting pre-approved for a loan, here is a list of the items needed to start that process. Basic identification, driver's license and social security card. We look at the most recent 30 days of pay stubs. So you get paid twice a month, just the last 2. If you get paid once a month, just your last 1 pay stub would be great. Previous years of W-2s and tax returns, just 2 previous years of those items. If you own a business, you're self-employed, we need the 2 previous years of your business tax returns as well. Proof of additional income if you're receiving child support, retirement, Social Security, alimony. Want to see an award letter on each of those types of income. And for your assets, we look at the 2 most recent bank statements. If it's a quarterly IRA statement, then we just look at your last quarter. And we want all pages. Sometimes there's a front and back. You want to make sure that you provide all the pages to those account statements. Once you gather all that paperwork together, we'll go ahead and collect all that documentation, and we'll go over the ins and outs of what programs you might be able to qualify for. Next, we'll have the underwriter review it all, your credit, income, assets, and issue a pre-approval for you at that time. We'll give you the letter, and you can use that letter to show sellers once you're ready to make an offer to purchase their home. Well, that concludes our presentation today for first-time home buyers. And if you're not a first-time home buyer, I hope the information was still helpful to you. Thank you so much for tuning in. I appreciate your time. If you do have additional questions or want more information, please visit my website. Feel free to call or email at any time, and have a great day. Thanks so much.